Chapter 3. Considering Deals. If you follow the last chapter's advice and start meeting people, you'll soon have a big problem. It's a good problem, yet it's a problem nonetheless. What's the problem? It's deal flow. You'll have potential deals flowing to you from the deal sponsors you're meeting. The deal sponsors will all be presenting you with their deals to invest in, and you, as a passive investor, get to choose one deal, or a few deals, or none at all. From an investor standpoint, having deal flow is good. After all, if you don't have any deals to consider, you can't invest. Yet it's the consideration of the deals that poses the problem. Right now, how do you make the right decision on the deals that your newfound friends, aka the deal sponsors, are presenting? Assuming the deal sponsors actually have a deal to invest in, as opposed to a scam, how do you choose whether to say yes or no to investing in it? Naturally, you don't flip a coin to decide. Heads I invest, tails I pass. Nor do you give serious consideration to the quality of the paper used in brochures describing the deal. There are obviously better ways of reaching a decision on potential deals that come your way. But what are those better ways? That's where this next chapter, Chapter 3, comes in. Over the course of this chapter, we'll be covering how you decide in a serious way on whether to invest in a deal. We'll do that by discussing 9 key considerations. Key consideration number 1, type of deal. The first of the key considerations is the type of deal. This means knowing what type of deal you're looking at. In commercial real estate, there are 3 types of deals. Each one varies based on the potential risk and reward. The 3 deal types are core, value add, and deep value add. Type number 1, core. Deals that fall under type number 1, core, are considered to be the least risky. That's because they consist of stabilized, fully leased and secure properties. These properties are often well kept, with the least amount of deferred maintenance. In addition, the properties may require little to no improvements for the new buyer. Collectively, then, deals in type number 1 can be considered low-risk deals. The low risk comes at a trade-off, however. The trade-off is that commercial real estate deals in the core category, i.e., type number 1, generally don't experience significant equity appreciation. Instead, type number 1 deals provide their investors with a stable, predictable cash flow. Another point on core deal type number 1, is that their properties are often the most liquid compared to the properties in other deal types. The liquidity comes because type number 1 deals involve properties that are stabilized with good marketable assets. Also, if you were to invest in a core deal type, i.e., a type number 1 deal, you'd probably deploy long-term non-recourse debt. That's the approach taken by most people who invest in this type of deal. Type number 2, value add. Commercial real estate investing deals of this second type target properties which have minimal existing cash flow. After acquisition of the property, a deal sponsor will then work to increase the property's cash flow over time. To increase cash flow, investors often fix deferred maintenance and remodel the property to reposition it. That specifically means investors may 1. Make physical improvements to the property so it commands higher rents, 2. Change tenant demographics, or 3. Improve the property management of the property. Once a deal sponsor, aka the new owner of the property, has successfully increased the property's net operating income, they typically cash out. Cashing out makes sense because it enables the investor to capture the resulting appreciation in property value. In other words, they get to enjoy the fruit of their labor. To cash out on a value-add deal type number 2, sponsors will either refinance the property in the deal or they'll sell it. Either of these actions will enable them to harvest the returns from their investment. Speaking of refinancing, you should be aware of how debt works when investors cash out. With respect to debt, any that exists is usually recourse or non-recourse, depending on the amount of value that's been added to the property and how fast the sponsor wants to cash out. Assuming a value-add deal type number 2 deal proves successful, Those who invested in it will typically enjoy higher financial returns than with core investments, deal type number 1. The higher returns on a value add deal come from the property's appreciation in net operating income.